So the theme of this panel is private sector M&A in KSA, but I think we'll find that one of the interesting themes is that a lot of KSA deal activity is cross-border in its nature, not all of it. And I think we've seen or heard from Philip earlier some very interesting themes. In a sense, he's told us what's going on here because our survey has actually asked the real deal makers themselves, the clients, the chief executives of the companies, has asked them what their current thinking is. So that was, I think, very helpful to set the scene for this panel. So I'm going to pick up on three main themes today. One is just going to be to look at trends in the private sector M&A market. Perhaps a bit of a quick look back, but maybe more with a focus on the future. I'm also going to then cover something really around strategies. What strategies do we see companies in the in M&A using here in Saudi Arabia? And then finally, I want to pick up on a general topic around governance of deals, and I'll pick up on some themes and touch on some points that that Philip made earlier. But just to get things going, I'm just going to ask panel members just to sort of say a little bit about what their experience has been briefly in the year to date in terms of M&A activity, what they've seen as being hot sectors, what they see in terms of geographies, the extent to which they've seen M&A be the primary tool that's been used, or joint ventures. But if I can open this to panelists, if you'd like to help us go first with that, please, Hassan. Yeah.
Sure. So thank you, David, for the intro. So if we go back first to the what's currently happening. So oil prices have dropped around more than 30% since November 2014. So oil prices have dropped around or more than 30% since November 2014. In addition to the geopolitical risks that we're seeing, and then all the other minor factors such as the Chinese slowdown in the Chinese economy, etc. All of this is weighing on the investor confidence. So the normal consequence of such volatility, etc. It's resulting in a volatility, and it's being demonstrated clearly in the volatility of the equity capital markets. So as such, a normal volatility in equity capital markets is going to be resulting in a drop in the or a softening in the M&A activity, and this is something that we have started to notice since the beginning of 2015 in the MENA region in general and in the Saudi market specifically. Now, on a positive note, we believe that this kind of softening in the M&A activity is going to result in again a pickup in terms of basically because the sellers and buyers valuation expectations, they're going to be kind of like refined, and probably they'll reach into a matching point. That's one thing. The other thing is that buyers still have the appetite and they have the liquidity in order to do transactions, and this is basically this gets confirmed through our discussions with CEOs, investment decision makers in general. And then finally, which is I believe is a very important point, usually with any drop in equity capital markets, this would result in a lockup of the IPO market. And currently in Saudi Arabia specifically, and in the region in general, the most important exit for any family-owned business is the IPO market. And with such markets getting locked, we believe that M&A private deals in general specifically are going to pick up. So we believe that there is the outlook is positive. Now, in terms of trend, as I mentioned, we've noticed a slowdown in the activity since beginning of 2014. This slowdown has been demonstrated clearly in the value of transactions. So in the Q3 of 2015, we've noticed that there's been a record drop in M&A transactions. I think the number was around $2.7 billion of transactions in Q3 2015, which is a record low in terms of past 6 years in terms of Q3. And we believe that we're going now through a transitional phase at which there is the market is moving from a seller's market to a buyer's market. So, and then, however, so we expect a 2016 to be kind of a moderated market in terms of M&A, and then subsequent to that, we would expect it to pick up again. This is based on, we're talking about historical.
Sorry, just maybe to add to that. What I'm seeing is more smaller type transactions sellers are looking for buyers, and these are transactions which you'd see the net income between 2 million to 5 million that don't meet the IPO threshold. Therefore, financial investors don't find that keen, because if they do invest in that, they don't see a window of exit, and their horizon on investment is 5 years. So these small transactions are being bought by strategics. But again, I agree to Hassan's point, there's a major valuation expectation delta. So a medium-sized business would want 15 PE, similar to trading comps, where a strategic buyer wouldn't pay no more than 5 to 8 times PE to make the deal accretive to him. That's just a point to add to Hassan's.
Yeah, well, thanks for that. And I think it's a very good point about small cap M&A, which we often tend to sort of think quite a lot about the private equity market in M&A, but I think in the small cap area, you're quite right. That's largely driven, that's a very much a private sector M&A activity, where there are particular reasons why that buying and selling is happening. And it does feel to me that we are in a bit of a transitional period. I thought it was quite interesting, Philip's research, where chief executives seemed quite positive, and a lot of people talking about deal pipelines and growth, but equally clearly some caution around oil price and public finances. And also, I think, and we'll get on to talk just in a moment about strategies, but a lot of quite interesting focus on where the deals were happening and why they're happening. So we'll get on to strategy in just 2 seconds. But Mohammad, we tend to forget that we tend to think of lawyers and giving legal advice. You see a lot of deals that you're working on. What kind of themes and trends are you picking up on?
So I think in terms of trends, I'd like to talk a little bit about sectors. Given the market conditions, what we've seen is that buyers are focusing now more on defensive sectors. So the region is still very attractive in terms of demographics. So you'll have many investors looking at healthcare investments, pharma, retail, consumer products, education. So these are very common themes, if you like, that we've seen recently in the market.
In quite traditional sectors in some ways. Yeah.
Exactly, and it's these sectors that will not be directly affected by the geopolitical situation. People will always still need education, healthcare, and so on. In terms of potential buyers, what we've seen in the market is that many of the regional PE houses are being very active, and I think that is linked to the size of the deals that are there in the market. They do work on mid-sized to small deals, and we've seen a lot of that. But also, more importantly, we've seen lots of international corporates who take long-term view on the market on the region, and look past what's happening in the region and all the volatilities.
So that's a good point. I think I see regional PE firms, their window for investment is 5 years, and their IRR is no less than 15%. So the IPO threshold companies that are out there are a handful. of transactions that go for trade sale. They just automatically go to the capital markets instead of doing a pre-IPO. But the companies that go and look for a financial investor or any investor pre the IPO is usually to help on the governance and controls pre the IPO. So we've seen transactions where they may need a financial investor to help on putting all the controls, the authority matrix, the governance before appointing a financial advisor to go public. But I personally haven't seen that many. The bigger M&A space are on the smaller type transactions because mainly because the entrepreneur or the shareholder wants an exit window and he can't go through the capital markets.
Yeah.
I'd like to build on what Turkey has mentioned. So in terms of, we've noticed the minority investments. So minority stakes continue to be setting the stage in terms of acquisitions. And that's because financial investors are the most active investors. In addition to that, we've noticed that small transactions, which are in the the small cap valuations, small capitalizations, which are less than $100 million, are the biggest number of transactions that are happening currently in the market. The ones which are 100 to $500 million, which are the most, most attractive to financial advisors and investment banks in general, these are quite limited. And so this is basically, in terms of trends, what we're talking about.
Yeah, and I just think, Mohammad, just to pick up on a point you made earlier about international corporations, I mean, one of the things I'm seeing is there's clearly a lot of focus in the kingdom on the importance of diversifying the Saudi manufacturing base and developing more value-added, more and more value-added industries. And I think I see a strong encouragement or push both to the larger Saudi groups and to the international corporations who want to do business here to create joint ventures. So I personally see some things that will drive some deal activity, and they may not be pure M&A, they may be of the order of joint ventures around some partnerships around international corporations and local Saudi partners. There's always been a bit of the landscape, but I think given the focus of decision makers on what they would like to see happening in the kingdom, my personal prediction is we'll see that driving quite a lot of strategies for international companies.
Yeah. So the thing I would add here is that probably many of us here have heard about the SAG's announcement that they're opening, for example, the trading sector up to 100% to foreign investors. So that's the tool that the government use to attract certain investors in certain sectors. Now, it's fairly new, but we expect that once there's more clarity on the requirements that SAG will require in this particular area, we'll see more and more M&A deals resulting from that, from foreign investors wanting to put more investment in the country and benefit from the 100% ownership.
Absolutely.
To add to that, when you mentioned the JVs, a lot of foreign investors would start on the greenfield stage with the investor. So currently I'm working on something very similar, where a foreign investor is coming in at the beginning of the project. So it's not M&A per se. It's setting up the governance at day one, and they're taking a control. They have a minority stake, but with control of the management and board. So I'm seeing a lot of those JVs. But in terms of pure play, foreign investor acquiring a majority stake of an existing business, again, I only see a handful happening. It's still not really common.
Yeah, I think that's absolutely right. Mohammad, you touched on governance and regulatory issues with a reference to Sajja. Obviously, there's a new company law here, and without expecting you to give everybody in the room some free advice on the application of the company law, perhaps you might just touch on a first take on how that might impact M&A behavior.
So, just for everybody's benefit, there has been a new draft law published by the Ministry of Commerce. The law has not been yet published in the official gazette. And I think there is 2 or 3 main themes coming out from that draft. I think the first one is it does give more flexibility in terms of requirements, process for setting up companies, and that, especially when we talk about closed joint stock companies, you know, historically, closed joint stock companies, there has been, with minimum capital requirements, with the number of shareholders required, they were not used often in transactions. With the new law, the law does decrease the capital requirements, the statutory reserves. Even in some cases, it allows a single shareholder to set up both an LLC and possibly a closed joint stock company. And that, you'll see, I think, the direct impact of that is you'll see closed joint stock companies being more and more used in transactions because they do have benefits over LLCs, which means also that there'll be more flexibility in terms of structuring transactions and growing business going forward. The other theme that comes out from this draft is it does improve the governance regime, again, particularly in relation to closed joint stock companies. You'll see that it was interesting that many of the requirements that were previously imposed, whether by practice or regulation, they were imposed on listed companies, are now required from closed joint stock companies, which are private. Notably, there is a requirement to have an audit committee in place. There is also the requirement that the chairman should not hold any executive positions within the company. Accumulative voting for electing board members is now mandatory. So that's all very positive. I think one of the direct benefit of this added governance, if you like, regime is that for companies that are looking to go public in the future, them adopting these, now having to adopt some of these governance structures will make them more ready when they go public to comply with requirements of listed companies. The last theme I would mention on this is that the law did try to codify some of the practices that has been accepted and has been there for a while. For example, it does clearly now state that General Assembly meetings can be held through new medium or technologies, which is also goes back to the point about flexibility in the new law.
Yeah, I mean, just on that theme of governance, I mean, clearly one way that boards can get comfortable that proper governance is being followed and will be followed in acquisitions that they're making is making sure that the executive management teams are executing those deals, are commissioning proper due diligence, legal and financial due diligence, making sure that there are proper integration plans in place, proper identification of which officers of the company are going to be responsible for which functions and so forth. Hassan, I don't know if you want to sort of pick up on some of those themes.
Yeah, sure. So before I get into that, there are a couple of points I wanted to mention on the previous topic. So I think one of the most important things is to make sure that whenever there is a decision to make any acquisitions is to make sure that there is a strategic rationale to do an acquisition, and then making sure that the strategic rationale is correct and it is being applied, implemented. So one, identify what's your strategic rationale of doing this transaction, and then next stage, at a later stage, once you want to make sure that you implement it and deliver it to the shareholders. That's a key point. And then the strategic rationales are the typical ones, which are revenue synergies, cost synergies, and or redefining the business. Given your business, the business might, or the industry might become obsolete soon. That's one thing I wanted to touch upon. In terms of where, so there are 2 points here I wanted to talk about, which are the geographic focus and then also the industry focus. In terms of geographic focus, we've noted, well, definitely GCC remains to be the champion in the MENA region. Saudi Arabia is the primary player or the primary target market, followed by the UAE, and then after that definitely comes the other GCC markets. And that's because of scale, of course, and demographies specifically. Finally, in terms of industry and industry specifics, there are different types of investors that we meet with on a regular basis. So there is the financial investor and the strategic investor. In terms of the strategic investor, definitely they're going to be investing in a relevant industry. They're not going to go beyond that. While on the financial investor, we've noticed that either they are the opportunistic. So if there is an attractive valuation, regardless of what industry we're talking about, they will be happy to get into. So despite, for example, we're talking now about a high volatility in the petchems, construction materials, manufacturing, etc. We've noticed that there is interest as long as valuations are attractive. Dislocated assets definitely will have, will attract buyers. And then finally, there are the defensive industries, which everybody, every single investor is keen about. And some investors are willing to pay a premium for these industries. Other investors are not, and they believe they are opportunistic, so they don't care about what industry they're getting into. That's in terms of the industry. So, and back to your point about structure and process. So I think this is something that's being applied currently, but I think it's a very important point to mention. The process at which transaction happens is as executive management gets the blessing from the board, and then after that you move to the next stage, or you're going to meet the board ultimately once you want their sign off on the transaction. It's very important that you don't surprise the board with like 10 or 12 major points and before kind of like at the last moment. So what we're seeing currently and what has been applied in kind of like good best practice corporate governance is to ensure that there is an investment committee on board, which would include members from the executive management and of course members from the board. So they'll get to know about any issues that are being addressed in the process or are being mitigated at the final stage of the transaction and in the SPA, etc. But and the way that it has been agreed, and there will be no surprises at the ultimate stage. I think that's a key thing that this is something that we think it's kind of like best practice and we encourage.
And to add to Hassan's point, it's very important for pre and post the transaction is for the new board members to have a chemistry with the existing board members, because if you're buying a 25%, you're not getting super majority. You have some say in the EJ, but if you're buying 51%, you'll have a board say. But if that is not the case in terms of the deal, you want to ensure that post transaction you have good chemistry with the board, because if things go wrong, it doesn't become chaos and it goes to legal. I know that you can protect yourself with the SHA and add things in the bylaws, but that can drag on. For having a unified board and having chemistry with the board member pre the transaction is very, very important, I've seen. Because conflicts in boards could drag and demoralize executive management, and you will see a turnaround of several CEOs. If board members are not aligned.
Yeah, I mean, I'm sure as advisors, we've all had the experience of some quite tough interrogations from good investment committees. And, personally, my experience is they very much want to focus on what due diligence has been done and the adequacy of that due diligence. And as we all know, it's one thing to do the deal. It's quite another thing to secure and build the value from that deal and integrate it. And so, in my experience, investment committees are very focused on the implementation and integration plans part of it. And I've got plenty of experience being quite tough grillings by investment committees who want to know what those arrangements are, sitting alongside executive management teams.
Yep. Just to build on what you just mentioned, David. So what we really recommend and encourage is exhausting due diligence. Do as much due diligence as you can pre-transaction and try to address any issues firsthand rather than relying on the reps and warranties and the indemnities, because that gets you into legal proceedings that buyers would not. This is something that nobody wants to get into, and it might take several years. In addition to that, we've noticed that in general, board members are more keen on due diligence. If you compare due diligence to a right price, you might overpay by 5-10%, and probably you will catch up within a year or two on the valuation that you've paid. However, if you do a mistake on due diligence, that could result in wiping out the whole business, if anything. So we really encourage exhausting due diligence as much as you can before signing the documents, because once you sign, you're in there. So that's very important. Another point that we would also recommend, and we've noticed, which is a key issue, operational integration. So one thing is basically planning for operational integration pre-closing, and the other thing is implementing operational integration. That's a key thing that we strongly recommend.
Okay, I mean, I'll just pick up a couple of points, and I'm keen, we've enjoyed this conversation so much, but I'm keen to take any questions from the floor. I mean, we were talking about strategies, and I thought what was quite interesting in Philip's presentation was, of course, market share and, of course, costs, but a theme that emerged also was the use of acquisition to secure the right kind of talent and human capital. And one of my experiences of strategic drivers has been the interest that companies have to use an acquisition to actually catalyze change within their own organization. So using acquisitions to bring about a cultural change and to secure talent needed to take the businesses into high value added growth areas. So I thought that was a very interesting theme that emerged from that. Look, I'd like to turn the session. We've got about 10 minutes left to questions from the floor. We very much enjoyed the conversation up here. I hope you found it interesting. But I'm very happy to take any questions that people have from the floor here on any of the topics that we've been touching on, or indeed anything else around private sector M&A in Saudi Arabia. Yes, please. I don't know if we have another microphone. Let me. I'll hand this microphone down, and whoever's going to answer will shuffle them on.
This question is directed to Mohammad, if I may. Yes, you talked about the new corporate law, or incorporation law, companies law, I'm sorry, in Saudi. Could you shed some light on the timing of its implementation? Because I know it has not been published in the Gazette. So what kind of time frame are we talking about? And a little bit more about what other features that people need to know about.
So with being a lawyer, I have to. Sorry. Yeah. So in terms of timing, I have to say it's still not clear. So it has been published on the ministry's website. It hasn't been issued through a royal decree. It hasn't been published in the official gazette. But from the day it's published in the official gazette, it's 150 days after that for the law to come into force. It's worth mentioning that it's a completely new law. The previous law will be superseded by the new law. In terms of other features, it's one of the main issues for people who were working a lot with public companies under the previous law is that the law itself actually was issued in the mid-60s when there was no CMA and there was no capital markets authority. And there was always a gray area between what actually falls within CMA's domain and powers and what what's with the ministries, what's within the ministry's powers. And one of the very good things about the new law, and I think the law itself is a step forward, is that it tried to make a distinction between what the CMA does, and it makes many references to the CMA and to the capital markets law in relation to listed companies. So that, I think, for public companies is very interesting. Another aspect is that, again, it builds on practices that has been there. So we all know there has been few public debt issuances. There's a new provisions in the new law which actually codify that and facilitate those issuances. So in terms of capital raisings, I hope that the new law will actually facilitate those more. Okay, so bankruptcy, I think there is a new law that is being drafted at the moment, which will deal with bankruptcy. The provisions itself, it talks about liquidation. There has not been a big revolution in those provisions, I have to say. But bankruptcy itself, I know it's being drafted by the ministry. Just also to set the scene for in general, we are seeing a big move in terms of regulations reform. So there is the bankruptcy law, there is the commercial agencies law. So there is a big work being done behind the scenes in order to improve the regulatory framework. There is lots of work to be done, especially in the public domain frame. But I think that the law itself is certainly, in my view, a step forward.
Just my question about the enforceability of earn-out structure in sale and purchase agreements. Usually you have, there is a big gap between the price, between what the seller is willing to divest at what price and comparing to what the investor is willing to offer. And especially in opportunities where there's a growth potential in companies. And my question that sometimes the seller and the buyer, they might have like a valuation gap and they might just agree on earn-out structure where, certain part of the purchase price can be paid at later stage. Just my question is, have you encountered, earn-out structure SPAs, and how about the enforceability of these terms and then SPAs?
Can I just pick up on the commercial point and then hand to the legal point? I mean, on the commercial point, it's a very good question about earn-outs, and I think clearly earn-outs provide an opportunity to bridge a buyer-seller gap. In my experience, the devil is in the detail. You've got to get those definitions very right, and you've got to ensure that the incentives for the parties picking up the earn-outs are aligned with the agreed objectives for the business. The worst case is where you've got incentives that encourage behavior that's distorted relative to the objectives you've got for the business. The second thing I would just say from a sort of commercial point of view is earn-outs can only bridge a value gap to a certain degree. I'm always concerned if I see the sort of the majority of a deal relying on an earn-out. So I see it something as being about a helpful means of bridging value gaps and a means of incentivizing behavior from the beneficiaries of that earn-out that's aligned to the business plan and the objectives that you're seeking to get. I mean, just before we turn to the legal issue, was there anything you wanted to add, anybody on earn-outs?
Yeah, I wanted to add one thing. Is I've seen a ratchet clause which is very similar to earn-out, which where if you don't meet XY EBITDA, then I end up getting more equity. When the business plan didn't meet, when it came to enforce the ratchet clause, it wasn't enforceable. So that's why I'm saying pre and post transaction, if you have alignment with your new shareholders and the board, it's more of an integrity matter than a legal matter. So that's what I've seen.
Yeah, so let me hand over the enforceability. If dangerously close again, Mohammad, to give you some free legal advice, but here we go.
So to answer your question, there'll always be doubt whether those arrangements will be enforceable. It depends on the clause itself. But you have to bear in mind that there are ways to mitigate that risk, whether through the drafting of the clause itself, whether through the choice of law, through the choice of jurisdiction. So there are ways to mitigate that. But this is not something that is only relevant to earnouts. And I have to say, we are seeing more and more earnouts as a way to bridge the gap on valuation. So we are seeing them more and more now. But this is not something that is the only thing that has a risk of enforceability. We always see put, call options, and these arrangements are invariably in any shareholders agreement we see these days. And people, they do enter into them knowing the risk and trying to mitigate the risk, but documenting what is the commercial agreement at least, so that in the right time you can point to something. So my advice to you is get good legal advice on this. That's.
I somehow thought you might say that, Mohammed. So we've got a little bit of time left. So we've got a couple of questions. We've got one there and one there. So let's go with this one here first.
Sure. Thank you very much. I'm Azam from the Lijam Group. Question for Mohammad or Rasheed. Mohammad, you mentioned about the role of chairman, segregation of duty between chairman not having an executive responsibility. Can you hear me, by the way? Could I repeat?
That?
Okay. You had mentioned about the chairman segregation of duties, that he cannot have executive responsibilities in new company law. There is a compensation limit in the existing law. I think it's a couple 100,000 Riyal per year or something. Is that been removed in the new law? Or do you have any understanding? Can you shed some light?
So you're talking about the 200,000 in the current law. So that limit has been increased, okay? And there has been additional provisions around the compensation of directors. So it has been increased from 200,000 to 500,000.
So is that a cap now? 500,000 is a cap for the chairman position?
For
we did
no,
not read
for
it
board,
that way.
for a board position.
Chairman.
For the chairman,
We understood that there was no limit now. The law was silent, at least the way we were interpreting it in our company. But I'd like to hear proper legal advice from your side. Not advice, but your
okay. No, well,
your understanding.
I think the law gives the flexibility now to increase it for the chairman. Okay, but if you like, the default position is 500,000, but the law gives flexibility for more. I hope that answers the question. There's no limit.
Okay, there's another question, and we may just make this the final question. I think.
Thank you. This is Sandeep Raghuvanshi from Swits Group. I just wanted to understand from you, what kind of financing structures do you see in the run-up to the expectation of probably the interest rates rising and so on? How do you see in Saudi Arabia most of these transactions being financed primarily from the leverage aspects? I don't know if any of the panelists could have a view on that.
Hassan, so there's a question about financing. What kind of financing and finance structures do we see putting in place for acquisitions, particularly if they're being acquisitions being made by family-owned groups?
Yeah. So, well, obviously there's the existing liquidity that a family could have, or currently we're working on a transaction and basically it's being financed by banks through a syndicated loan or something like that. So that's, kind of like the typical syndicated loans, sukuks, etc.
I meant primarily from the levels of debt that you see in the transactions.
So maybe just to add, I've seen acquisitions where there is acquisition finance, where banks understand that and would take out the target's cash flow as a security, but and not a lot of banks tend to like acquisition finance, but there has been transactions depending on the target and the cash flow stream that's coming from the target. So you see 60, it could go up to 60% of the acquisition price. On the real estate side, they've been active because they get not only the cash flows, but they get the title deed, so that protects the bank, so they're covered. But on acquisition of an existing business, getting recourse on the cash flows and is sometimes accepted and sometimes not, depending on the bank's sophistication.
But in terms of let's say comparable benchmarks in terms of debt service coverage ratios, etc. This is quite relevant in terms of the industry itself. So every industry has its own DSCRs and specific to it. So if you're talking about a retail industry, it has a certain number. If you're talking about healthcare, it's completely different. So it varies.
Thank you.
Can I ask you a question? Do you think that, given again the market condition, if also cash is king now, do you think that there'll be other ways to finance? Is there going to be equity capital raisings more through private placements? I'm not sure if you have any thoughts on that or any previous experience.
In terms of just going back to probably the question of the gentleman, so we are currently seeing still banks financing transactions. So we don't see any liquidity crunch per se. So if it's quite a wrong or misperception that banks are not financing this, because we are going through financing of M&A through acquisition finance. That's currently happening. We're working on transactions that financing is being arranged for these acquisitions. Now, as an alternative to doing acquisitions, will always be an equity increase. However, then you're stuck with two transactions rather than one, which only complicates things more.
And maybe to add to that point, as the capital market valuations are not attractive, you're seeing sellers now looking at the trade sale element, and these are the big cap, similar to 2009. So there was acquisitions that were sold in 2009 when the market was down, and then when market picked up, financial investors took the opportunity to capitalize on the return.
Excellent. Well, thank you very much. We're very keen to keep to time here, and I'll certainly be around the premises. Hopefully some of our fellow panelists will, to pick up on any questions at all. So I'd like just you to join me in thanking Mohammad, Hassan and Turki for participating in the panel, and hopefully you found it a useful and interesting discussion. But thank you very much to our panelists.